Welcome to our presentation. Today, we wanted to speak to you about the new AICPA valuation guide that was finalized and published recently in final version. It was put out by the AICPA Private Equity and Venture Capital Task Force, and it's entitled Valuation of Portfolio Company Investments, Venture Capital for Venture Capital and Private Equity Funds and Other Investment Companies. So we're really glad that you're able to join, and we know that there's quite a variety of people that are out there in the audience as far as the different levels of valuation skills and knowledge that you might have. So this presentation is meant to primarily introduce the contents of this guide to you from a pragmatic perspective. Just off the bat, we want to emphasize the significance of the publication of this guide. This guide was developed over 6 years, and its final publication is really welcome in the valuation arena and the public accounting arena, because there's been so much diversity as to the different types of valuation methodologies and practices out there. So this guide really seeks to eliminate a lot of that ambiguity and put forth best practices as it relates to valuation for financial reporting for all different kinds of funds and all different types of investments that span the investment cycle, from very, very early seed stage VC all the way through later stage private equity, as well as BDCs and debt valuation. Just to emphasize the importance of this guide before we get into the detail and the content of it, we just wanted to let everyone out there know that over the course of the last couple of months, we've gone to certain conferences and we've gotten feedback about the guide and its use. And we do know that regulators such as the SEC have awareness, obviously, of the fact that this guide exists, and they've actually asked certain reporting entities as to why they might not be following these best practices, because they are out there. So we just want everyone to be aware of that, just to emphasize the significance of the guide. And then also, it's important to let you know that public accounting firms, they're compelled to review the valuations that are put forth by their clients in the context of these best practices. So the purpose of the guide, just to really reiterate really quickly, it was developed for investment funds and venture capital funds, auditors, valuation specialists, and to put forth best practices and to identify certain requirements under ASC 820 and also provide best practices. So what I really want to do, because the guide is so broad, 600 pages, is just really gear this presentation to the practical, pragmatic aspects of this guide. This guide, in those 600 pages, there are numerous pages dedicated to practical examples in case studies of actual valuations that are meant to really delineate for the preparers of financial statements, auditors, and valuation specialists these best practices from a practical standpoint. So that's obviously something that is really important from the perspective of risk management, because there could be, you know, tons of theory out there, but practical application of the theory is really what all of us need, and that's what the guide definitely provides, and that will be the focus of the presentation today. So right off the bat, also, I wanted to let everybody know that the guide is published by the AICPA and it's copyrighted by the AICPA. So unfortunately, because of the copyright laws, we are precluded from sharing the detailed examples that are in the guide with you today. But you can purchase the guide. It's about $120. It's available at the website that you see here, and it's definitely worth the price for everyone out there who is responsible for estimating fair value for different types of investments in different types of funds. It's also valuable for anybody out there who is responsible for estimating fair value and signing off on fair value for not only level 3 investments, but also level 2 investments for maybe some public shares that might not be traded very frequently, those that deal with broker-dealers a lot, and those who value debt. So it's definitely worth it, and hope you'll avail yourselves of purchasing the guide as you try to put together your valuations for the busy season coming up. So really quickly, I just want to give you a broad overview of how the guide is structured. So there are 14 chapters in the guide and several appendices. The chapters are broad and they cover all different aspects of valuation for investment funds. And I think one of the most important chapters is chapter 14, because chapter 14 really just puts forth frequently asked questions that cover a broad range of different types of investments and valuation issues that preparers, auditors, and specialists run into all the time. And I guess I think the best way to start familiarizing yourself with the guide would be to go to chapter 14 and actually look at the frequently asked questions, because then the answers will guide you to the other parts of the guide that are specific to your type of investments and the questions that you might have that are more detailed in nature. And I think the second most practical section of the guide is Appendix C, because Appendix C provides those case studies that we mentioned earlier, actually take you through valuations of different types of investments from the original investment date all the way through a liquidity event like an IPO or a sale, or maybe if you're not fortunate enough, a liquidation. And they take you through examples of debt valuations, and they involve all different types of industries like real estate and biotech. And so if I were starting with the guide and I hadn't looked at it yet, I would definitely start off with chapter 14, and then I'd take a look at Appendix C and find out what case studies really are most relevant to the types of investments that I'm trying to value. This is just a reiteration of what we just talked about. This is talking about what's in Appendix C, those case studies that are really such great examples for everyone out there who's dealing with valuation. Again, they go through, these case studies take you through early stage venture capital across all different types of industries and demonstrate in a lot of detail how to approach valuations for your investments at different stages of investment, and again through all different types of industries. So what are some common valuation issues that these case studies actually illustrate, and how practical are they, and why should I really take time to learn about what best practices are within these case studies? So here are some examples of what these case studies actually address and demonstrate and delineate as far as valuation goes. So one example might be common situation. If there's a recent financing round, when is it considered reasonable to price all the classes in my capital structure at the same price per share? So there's a case study that addresses that. If a portfolio company isn't generating any revenue yet and it's at a really early stage, is it reasonable to leave my fair valuation indication at cost, since there's no indication that I have right now as to how the next round might price? That's another case study, and that addresses that issue. And then another case study, an example, would be what valuation methodologies should management consider when there hasn't been a recent financing round? relative to my valuation date. So these just give you kind of an idea of how practical and actually pointed and on point these case studies are in trying to provide financial statement preparers and reviewers with best practices in a very practical way, in a valuable way. And later on in this presentation, we'll address each one of these. So before we do that, I just, again, knowing that there are different people in the audience with different levels of familiarity with valuation and with the guide itself, just want to quickly go through some of the more relevant chapters just to show you what best practices and standards that the guide addresses and what you can plan to learn from availing yourselves of its content. So chapter 2, it's really geared towards giving the reader an understanding of what is fair value from a financial reporting perspective and what are its related concepts. So it goes through briefly the definitions of ASC 820, IFRS 13, and the GASB equivalent. And I guess the most important thing to take away from this chapter would be to really remember that fair value is predicated on a hypothetical sale of your investment. So it's the price that would be received to sell an asset or to transfer a liability in orderly transactions between market participants at your particular valuation date. Chapter 3 really focuses and emphasizes the importance of including market participant assumptions in your valuations, in the key inputs, and it defines what market participant assumptions are and gives you examples of those. So market participant assumptions reflect assumptions that buyers and sellers in the most principal or advantageous market for your particular investment would make when they're trying to figure out what they'd be willing to buy your investment for, or you'd be willing to sell your investment for. So some important aspects of market participants' assumptions to keep in mind are that the market participants in this hypothetical sale of your investment are supposed to be independent of each other, right? So they're not necessarily related parties because you want as much of an arm's length reflective value as possible. That both parties that are negotiating that fair value at that price have a reasonable knowledge and understanding about the investment and the transaction, and that both parties are actually able to enter into the transaction and have the level of knowledge and sophistication to be able to negotiate that price. So for purposes of what we're talking about today, market participants are investors that are willing and able to transact in the investment being valued at the financial reporting date. Market participants and the information that's evaluated depends on certain characteristics of your investment and also the portfolio company. So the portfolio company, when market participants are figuring out what they're willing to buy and sell a particular investment for, they're obviously taking into account the industry that they're in, the stage of development of the company, what's in the product pipeline, what are the market opportunities for growth and gaining market share, and what's the management depth. In particular to the actual investment or position being valued, it's important for market participants to understand and negotiate from the knowledge of what the economic rights are for that particular class of equity, what's the downside protection, what are dividend rights, what's the upside, and what are some non-economic rights, including information rights, covenants, and board seats. And then the other aspects that market participants take into consideration in determining the price is the industry and the overall market conditions on a macro level. The guide emphasizes very heavily the unit of account in the determination of fair value for a particular investment. So what really is that from a practical standpoint? Well, it's your investment's it's your particular investment and what economic control rights are associated with that particular investment. So for example, a unit of account is a particular share in a particular class, and all of the rights, restrictions, and advantages that go along with that particular share, as an example. It's important to be mindful of any control rights or minority positions in a particular unit of account. And the guide also emphasizes the fact that a particular entity or owner of an investment might actually be able to aggregate their various positions in the capital structure of a portfolio company and aggregate it as one unit of account. So for example, an entity might own both debt and equity in a particular portfolio company and exercise control over that entity, so that that particular unit of account is not necessarily at the individual share or the individual loan level. It can be aggregated to a controlling position based on the fact that that entity owns both debt and equity in the capital structure. This slide is really just meant to illustrate for you the fact that when market participants, or re-emphasize the fact that when market participants are negotiating and figuring out what they'd be willing to buy and sell a particular investment for, that the unit of account is very relevant, because if you have control over an entity, you have access to maybe more of a return and the ability to exit and put forth a liquidity event, and that all of that translates into, or could translate into, additional value for your investment. Calibration is actually required by ASC 820, right? So GAAP and FASB require preparers of financial statements to consider calibration, and Chapter 10 of the guide does a great job of explaining what calibration is, providing examples, and then again in that Appendix C with all the case studies that we talked about, there are countless examples of calibration for the reader from a practical standpoint. So really, what is it and why does it matter? Well, what it is it's a way to gear your valuations at various measurement dates and reconcile valuations to specific assumptions that were made at prior transaction dates or prior valuation dates. So for example, when an entity makes its original investment in either an equity or a debt position, there are a certain set of assumptions that go into that original investment relative to for example, what multiple of revenue might we pay for our share, or what's a reasonable yield on this particular debt investment, and how long do we plan to hold this investment until an exit. So those types of considerations at the original investment date are what drive the price, right, originally at that date. So all of those assumptions can be documented and considered going at that point in time, and then at subsequent valuation dates, the preparers of the financial statements will calibrate back to that original transaction date or that prior valuation date and make a determination, a comparison. What's happened at the portfolio company since the last investment or the last valuation date? How's the company done? What's going on in the industry? What's going on in the economy? And how should I change those key assumptions that went into my prior valuation or went into my determination of the original price that I paid? So, for example, really quickly, if an entity bought in to a particular equity investment in a portfolio company at 3 times revenue, at one point in time at the investment date, and then a year later, the portfolio company's done much better, and the market, as evidenced by guideline companies, shows that market multiples or revenue multiples in that particular industry for those guidelines have gone up by, twice the amount, then the preparer of the financial statements would basically make a determination and say, well, all things being equal compared to last year, I know I've done better, and I know the industry is up, so maybe I should consider valuing my company at 6 times revenue this year. That's an example of calibration, and there's many more detailed examples in the guide, and also some that become much more sophisticated than that. So Chapter 5 gives a very detailed and excellent overview of valuation approaches or methodologies. And it's important for you to understand that the guide actually does give examples of how to make determinations as to appropriate valuation methodologies for both valuing the portfolio company and then valuing your particular investment in the portfolio company. So it's really providing guidance and best practices at both those levels. And the guide emphasizes the fact that when you're deciding what valuation methodology to use, you really need to look at it from a market participant perspective. So from the perspective of someone who's coming in, stepping in your shoes and looking to buy your investment from you, what's the most reasonable valuation approach that that market participant would employ? It obviously involves judgment and consideration of the facts and circumstances of the portfolio company and the characteristics of the particular instrument or security that's being valued. Some of those considerations relate to the business operations, the stage of development of the company, customers and competition, the exit strategy for the investment, and economic and control characteristics of the particular instrument or investment that's being valued. The overview that Chapter 5 gives, and a lot of people in the audience might be familiar with these, but obviously all of the valuation methodologies and approaches are reflective of some version of the 3 main valuation approaches, which would be the market approach, the income approach, and the asset or cost approach. I wanted to put this in here just to let everybody out there know that the guide does address the valuation of debt investments. So it gives a lot of detail and example on determining the fair value of an instrument when debt is the unit of account. And it highlights some characteristics of debt that obviously need to be taken into consideration in the valuation of these types of instruments, like change of control provisions, how to determine synthetic credit ratings, prepayment features and the impact on valuation of those. And then it goes into, the guide goes into an area of how to value debt, how to account for debt in the capital structure when you're ultimately trying to value equity, but your portfolio company has debt balance. And then the guide also emphasizes valuation related to the decline in the fair value of debt and how that affects the value of equity of a portfolio company. I'm skipping around, but I'm saving a lot of the examples and more practical aspects of things towards the later stage of the presentation. So I just wanted to get these concepts out there really quickly. So Chapter 9 of the guide, it's important because it addresses the impact of value on your particular investments as it relates to control and marketability. So a lot of people in the audience might be familiar with the application of control premiums in certain valuations, and then the application of marketability discounts in certain valuations that they've performed in the past or that they've reviewed in the past. And really what the guide does is it emphasizes to the reader that, it's not an automatic application of a control premium or a marketability discount in fair value estimations for financial reporting purposes. The guide addresses the fact that there might be some situations where the addition of control premium isn't necessary because the cash flows that are being used in the valuation already reflect an aspect of control, or that taking an extra discount for marketability might not be reasonable because the fair value and the calibrated value that's already been determined already reflects the fact that a particular investment is privately held. So I guess the key takeaway here is please understand that what the guide is saying as far as best practices go is that you shouldn't necessarily automatically think that you should be applying control premium if your investment is in a control position, or you shouldn't be applying an automatic marketability discount if you own a minority interest in a particular investment. The guide also emphasizes pretty significantly that best practices should include backtesting. The task force, the AICPA task force that put together the guide, believe that this backtesting is a best practice for investment companies because it's obviously a way of judging how reliable and reasonable your fair value modeling and fair value determinations are. Chapter 7 provides guidance on valuations for portfolio companies that have simple capital structures, so one class of equity basically, and it provides examples of that. And then we get to Chapter 8, and Chapter 8 is pretty voluminous relative to the other chapters because this is really where there's a lot of detailed guidance and best practices and explanation put forth as it relates to valuing investments in portfolio companies that have complex capital structures, meaning more than one class of equity. And so probably most of the audience understands that when there's more than one class of equity, that means there's more than one level of negotiated rights to the equity in the company and the profitability of the company over time. And so modeling out and considering those economic and control differences between the different classes, it can get complex, but it's not necessarily complex. And that the guide says that a lot of that depends on the nature of the investments and the portfolio company stage of operations. And we'll see that going forward. Chapter 8, it's pretty practical, but a lot of the concepts in Chapter 8, again, are readdressed and shown in examples in the case studies. Let me just go back really quickly, sorry. I just want to really quickly lay out for you what the guide puts forth as best practices for valuation methodology when you need to apply an approach for valuing different classes of equity in a company with a complex capital structure. So some of the more common approaches to valuing equity in complex capital structures, there's valuations that are done through scenario-based methods, and we'll go through those in a few minutes. There are valuations that allocate equity across different equity classes through option pricing models. The guide talks about the current value method, which is sometimes also called the waterfall method, and when that's appropriate for valuing equity. And then the guide also describes hybrid methods, which are hybrids of scenario-based and OPM models. And then finally, Chapter 13, it's kind of a catch-all special topics chapter that addresses a lot of one-off valuation items and issues that weren't already captured in the previous chapters and aren't necessarily part of the frequently asked questions in Chapter 14. A lot of Chapter 13 is geared towards level 2 investments that have to do with PIPEs, publicly traded stock, restricted stock under 144A. It gives best practices as it relates to broker-dealers, dealing with broker-dealers, dealing with insider financing rounds, offers, LOIs, early stage companies that haven't had any recent financing rounds. It addresses the impact of dilution and gives some examples of how to account for that. It addresses options and warrants valuations, private fund interests and contingent consideration, and practical expedience NAV, and also secondary transactions. So there's a lot in Chapter 13, and that's also a pretty practical chapter as well. Okay, so now we're getting to more of the real focused and I would say more equity focused issues and examples in the guide. Chapter 14 is the guide that includes all the frequently asked questions that the task force pulled together. And as we mentioned earlier, this is a really valuable chapter, and it's probably, like I said earlier, one of the first chapters I would go to get through understanding where the guide's best practices are relative to a particular type of situation. So I wanted to put some examples of some of the frequently asked questions and the answers that are in the guide, just to give you an idea of just how valuable this chapter is. So one of the questions that I chose to include is there a rule of thumb for a time frame during which it's permissible to carry investments at cost from the date of original investment? So for example, is there like a rule of thumb that says I can hold this at cost for 1 year and be okay? And basically what the task force is saying through the guide is that there is no rule of thumb. It's a case-by-case basis, so that yes, the original cost basis might still reflect fair value at a subsequent valuation date, but that there has to be a rationale to price fair value at that original cost. Namely, not much significant has changed at the portfolio company since then that would either increase or decrease value, and there hasn't been much going on in the economy or in the industry to warrant an increase or decrease in value. So I know that's probably a pretty relevant for VC, that concept, and that's a large part why we included that here. Another question that comes up pretty frequently in VC or very early stages, my portfolio company isn't generating any revenue yet, so can I just leave it at cost since I don't know how the next round is going to price? And what the guide and best practices through the task force and the guide is saying is they're saying that no, you can't just leave it at cost because you don't know how the next round is going to price. It's true that costs could equal fair value again at a subsequent reporting date, but that there has to be some consideration given to calibration and changes in the value of the company or milestones that might have been met or missed in between those two valuation dates. And again, consideration being given to company-specific progress and market conditions at your current valuation date. So going forward in the presentation, I'm going to highlight where you can find in the case studies in Appendix C of the guide examples of calibration and VC valuation, but I wanted to include this frequently asked question and the answer, just so that everyone would everyone in the audience would understand that at this point, best practices is indicating that you can't hold things at cost just because you don't know how the next round is going to price. I also wanted to include an emphasis on what the guide's putting forth as best practices as it relates to early stage companies that haven't had any recent financing rounds. And again, you'll see examples of this in the case studies and in the Appendix C, but I wanted to highlight it here because so many of our clients are faced with this type of fact pattern. So luckily, the guide addresses it, and what they're saying is that preparers of financial statements, really the best choice would likely involve a valuation methodology that rolls forward the value that's obtained from a prior financing round that's then calibrated. Again, we're going back to that calibration. That's then calibrated to the present valuation date by comparing how has the entity performed in accordance with its business plan. Have any significant valuation events, either internal or external, occurred since the round? Does the entity need any additional financing to get to an exit event? And are there any attempts at raising any additional financing at the measurement date? So what the guide is saying is that unless circumstances suggest that nothing of significance has occurred since the most recent transaction, the updated value should carefully be tested for reasonableness and supplemented with additional scenarios as necessary. Really quickly going back just to show you some more examples of some more frequently asked questions and their answers. There's a question that deals with the treatment of valuing equity interests that have different liquidation preferences. So here, this question is related to how should my valuation appropriately capture the fair value of higher ranking senior and lower ranking junior classes of equity. So this frequently asked question in chapter 14 is directing the readers back to the examples that are in the case studies for illustration, but what it's saying is that obviously in some situations seniority in an equity position or lack thereof is going to have a definite significant impact on the value of the equity interest, but in some other situations maybe those liquidation preferences and other characteristics of those senior equity positions aren't going to have any effect on value at all. So at very early stages, the expected outcomes for portfolio companies and the investments that are made in those companies can be reflective of what can be considered to be bimodal. So there's either going to be some value at a liquidity event at that point in time, or there's not going to be any value to any of the equity holders because the risk profile of the investment at that point in time is bimodal. So in a situation like that, the guide is saying there's really more likely not going to be any real value to any differences in the liquidation preferences of the preferreds. So we wouldn't expect there to be any difference in the value of those different classes. But if on the other end of the spectrum, the portfolio company starts to meet some milestones and generate value, there might be, as it moves out of that bimodal all or nothing operating stage and starts to meet those milestones and generate some value, there actually might be differential value that could be attributed to different liquidation preferences on preferred stocks in the capital structure. So the analyst and the reporting entity needs to consider that in their valuation. And actually the selection of the actual valuation methodology that they decide to employ. And that is a nice segue into this next frequently asked question that's a part of chapter 14 that has to do with using post-money valuation indications. This Q&A is an illustration of the guide's position or the task force, excuse me, the task force position on using post-money value. And basically what it's saying is that, as we said in the earlier example, in instances where the company is in a bimodal stage where it's so close to an exit that everyone's going to convert more likely than not at the same price, or it's so early on in its operations that there's no real value yet that can be attributable to different liquidation preferences, that using a post-money value indication is reasonable. So it's so important to know that it's fact and case by case specific, but that the task force is indicating that using post-money valuation indications, it can be reasonable. It just depends on the circumstances. The next frequently asked question that I thought would be really relevant to introduce you to today has to do with using different valuations for earlier and later rounds. And it's really, again, the guidance is really gearing back towards it depends. And it depends on what stage the portfolio company is in, how much value has been created at the company, and what the rights are of the different equity classes in the capital structure relative to where the portfolio company is at and how much value has been created. Okay, I just want to make sure I'm good with timing. Okay, I added this section of the presentation because I wanted to get more technical and show you our Withum summary of what the guide is saying best practices are, and how does the guide explain how to select valuation methodologies when you have to value equity across portfolio companies that have complex capital structures, because that is obviously one of the most challenging types of valuations that our clients and their third-party valuation firms that they might hire need to perform. So I think we touched upon this earlier, but I guess I just want to keep re-emphasizing this. The guide itself, in the case studies in Appendix C, and we've highlighted for you here the actual case study numbers in the guide. So it's case studies 9 and 10 and 11, and some of the answers in chapter 14 that we just went through. These are the actual examples and case studies that really drill down in great detail and explain and illustrate how preparers of financial statements and those that review them can value and allocate equity through different valuation methodologies, the equity investments in companies that have complex capital structures. So if you remember anything from today, remember case studies 9, 10, and 11 for everybody out there that deals with companies that have complex capital structures, because these are really the most relevant to you. So I'm going to give you a really quick overview of what the guide says and how do you do it and what are the right valuation methodologies to use. How do I, once I figure out what the total equity value is of my portfolio company, how do I allocate that total equity value across series A, B, C, D, and E, and my warrants and my profit interests and all the other components of my capital structure? The guide just keeps emphasizing calibration, right? It emphasizes calibration across different valuation methodologies, across subsequent financing rounds, and I can't emphasize this enough, the fact that GAAP and FASB require calibration really really means that you really need to consider it in your valuations. And if you do consider it and you make a determination that it's not necessary for your particular valuation date to really illustrate an example of calibration, think best practices are saying that you should document the fact that you considered it, but calibration isn't necessarily relevant to your particular investment at that particular valuation date. And again, here what we've done for you is we've identified for you the actual case studies in the guide that illustrate really good examples of calibration for all different equity investments at different stages of a company's operations. So again, it's 9, 10, and 11. So what are some of the criteria? What is the guide saying that I need to consider when I'm trying to figure out what's the right methodology to allocate my equity across my capital structure? The guide's saying you need to consider the portfolio company stage and the nature of its operations. So remember, if we go back, if it's a really early stage company where if the company doesn't meet its next milestone, it's going to go out of business and nobody's going to really get anything out of their investments, then it's in a bimodal stage, and maybe you can use a post-money valuation. So you're considering that stage of operations, you're considering how long from the valuation date till the expected liquidity event, how many more financing rounds are required until that liquidity event, how's that going to impact my valuation, maybe there's going to be some dilution that I need to take into consideration because of that. And then the third item here goes back to something we talked about way earlier. I need to really understand what the economic and control-based rights are for my investment of my shares when and the others, right? The other shares in the capital structure. If I own Series B, I really want to understand what the rights are for Series C and Series A, because that's going to impact how I figure out what I'm willing to sell my investment for. And so the guide is emphasizing that, and it's saying that, you know, the selection of methodology needs to consider what the economic control base rates are of your particular investment. And also, really quickly, you'll see as you go through the slides, and just as an aside, this presentation is being recorded, so we will make it available to anyone who wants to, I don't know how many of you will, but wants to listen to it again or get, have access to the content. So we would be able to email a link to you, and so just be aware of that. We've included also, in addition to the identification of the case studies that are really relevant, we're directing you to see also Chapter 8 of the guide in exactly certain sections that are drilling down on how to select the right methodology for your particular type of investment. So you'll see I have up here, see Chapter 8, begin at this line in the guide. So it takes you right there. This slide is just really re-emphasizing the need for valuation analysts to understand what the control and economic rights are for each share class. So for example, if new investors negotiated for seniority or greater than a 1x liquidation preference in a portfolio company, those negotiations themselves may provide an indication that liquidation preferences do matter, and maybe I can't use a post-money valuation that doesn't take into consideration the equity allocation, the differences in liquidation preferences between A, B, and C. This slide is just re-emphasizing when you choosing your valuation methodology, the task force requires you to think about what's the liquidation or exit strategy around that particular investment. How close is the portfolio company to succeeding in either having an IPO or some type of merger or sale? Or is the company at some kind of like midpoint where it's actually generating some value to where there's some differential, there would be some differential in value between the different classes of equity at the valuation date? Or is the company at a point where it doesn't look like, unfortunately, things are not looking good at all, and investors, regardless of what class of equity they are invested in, are more likely than not going to receive anything of a material value. So again, understanding the stage of the company's operation and what the exit strategy is relative to the valuation date is important in determining what valuation methodology to choose. So the guide describes several methods for valuing the equity interests in capital structures and allocating that total equity across the capital structure. So the methods that we're emphasizing here don't include the option pricing model. In the interest of time and to keep this simple, more simple than not, we didn't include OPM. The guidance doesn't mandate use of OPM, and so we think it's important for everyone in the audience to understand how the guide, that the guide actually does address use of OPM, and that it's not wrong to use OPM in certain circumstances. We just didn't include it here. So just want to make everyone aware of that. We didn't leave it out without realizing that the guide, does include it. But we, knowing that the guide doesn't mandate OPM, we've chose to focus on more pragmatic approaches here, more pragmatic valuation methodologies. So because they're just as relevant in allocating that equity value across different capital structures and the investments in those capital structures. So this, the first methodology is based on scenario-based methods. And then the second methodology that we're going to talk about today is the current value method, which a lot of people in the audience might also recognize as the waterfall method. And these are also, these methods are also illustrated in case study number 9, 10, and 11. So the first type, the scenario-based methods, they are focused on a method that we talked about earlier, post-money value, or a range of future values allocated to the different equity positions in the capital structure discounted back at present value to your valuation date. Really quickly, there's a simplified scenario analysis, which you can see more about in Chapter 8 at line 8.20. But basically, this is just another way of describing like a post-money valuation, a fully diluted equity valuation. The simplified scenario analysis, it's appropriate according to the task force if the distribution of the portfolio company's outcomes is at the valuation date that you're dealing with is still expected to be that bimodal, all or nothing, with immaterial value on the downside, so that liquidation preferences really aren't going to generate much of a return for anybody. I just want to make sure I can get through everything. This is just more on the simplified scenario analysis that we just described, where you can read more about it, and reconciling it back to post-money valuation, and also addressing calibration, which we've talked about. The next type of scenario analysis is the relative scenario analysis, which you can also read about in Chapter 8 at line 8.24. And this is the type of analysis that is appropriate for portfolio companies that have moved out of that bimodal early stage and are now in a stage where they've met some milestones or they've moved forward in their business plan, and some more revenue maybe has been generated, some profits maybe. And so there might be more of a reasonable expectation for the different classes of equity in the capital structure to have some value attributable to them, relatively speaking, based on the rights that they have as either Class A, B, or C shareholders. This is just giving you more information about the relative scenario analysis and equity allocation method, and directing you to, again, see these particular case studies for examples. This slide, I just kept in here because I wanted to emphasize the fact that dilution and examples of the impact of dilution in these types of valuations is a part of the best practices consideration and valuation methodologies that are illustrated here. And then the final scenario analysis is what the task force is calling a full scenario analysis, and a lot of people in the audience might recognize it as PWARM. And what the task force is saying is that full scenario analysis is more applicable toward portfolio companies that are very far along in their development, are pretty close to some kind of exit event. And you can see an example of full scenario analysis in these case studies as well. The next valuation methodology that we're going to address really quickly today is what the task force is defining as the current value method, which a lot of people also consider the waterfall method, and what you can read more about it in Chapter 8. And what the task force emphasizes here is that it's not wrong in all cases to use the current value or waterfall method, but it's only reasonable to use it in certain circumstances. So because this method isn't forward-looking, it's not capturing a lot of the optionality value that is so prevalent in early stage companies and private companies. What the guide is saying is that the current value method is most reasonable in situations where either the portfolio company is really close to some kind of exit or liquidity event, or where the investor, depending on their unit of account and the equity control rights and economic rights associated with their shares, or they actually have a controlling interest in the portfolio company and are able to effectuate some kind of a liquidity event or sale of the company. So those are the two scenarios or fact patterns where the task force is saying that the current value or waterfall method makes the most sense. And then I guess you could also argue that in the worst case scenario, if your portfolio company is not doing well and there's a liquidation that's planned and it's coming up relatively close to the valuation date, that doing some kind of orderly liquidation scenario is another version of a current value method. And there's actually a frequently asked question about that in the guide, Chapter 14, that addresses that, and I wanted to add that here. So I think we're running out of time, and I wanted to let everybody know also that any questions that anyone's put forth in today's session, we will address and we'll send out answers to. We have the list of participants, and we really thank you for taking the time out today to not only listen to the presentation, but also put forth any questions that you might have. So definitely want to be respectful of that, and we will respond. And also, again, this has been recorded, and we will be happy to send out links to the content and the recording of today's session for future reference for everybody who's been a participant. So thanks very much. And also you can feel free to contact me. Sorry, you can feel free to contact me, Michelle Keys. This is my contact information here at Withum. And I thank you very much and look forward to working with you this busy season. Have a good day.